In finance, a loan is the transfer of money by one party to another with an agreement to pay it back. The recipient or borrower incurs a debt and is usually required to pay interest for the use of the money. The document evidencing the debt promissory note will normally specify, among other things, the principal amount of money borrowed, the interest rate the lender is charging, the rate of repaying a loan entails a reallocation of the subject asset for a period of time between the lender and the borrower. The interest provides an incentive for the lender to engage in the loan. In a legal loan, each of these obligations and restrictions is enforced by contract, which can also place a borrower under additional restrictions known as loan covenants. Although this article focuses on monetary loans, in practice any material object might be lent. Acting as a provider of loan is one of the main activity of financial institutions such as banks and credit cards companies. For example, for other institutions, issuing of debt contracts such as bonds is a typical source of funding. A secured loan is a form of debt in which the borrower pledges some asset as collateral. A mortgage loan is a very common type of loan used by many individuals to purchase residential or commercial property. The lender, usually a financial institution, is given security, a lien on the title to the property until the mortgage is paid off in full. In the case of home loans, if the borrower defaults on the loan, the bank would have the legal right to deposit the house and sell it to cover sums owing to it. Similarly, a loan taken out to buy a car may be secured by the car. The duration of the loan is much shorter, often corresponding to the useful life of the car. There are two types of auto loans, direct and indirect. In a direct auto loan, a bank lends the money directly to a consumer. In an indirect auto loan, a car dealership or a connected company acts as an intermediary between the bank or financial institution and the consumer. Other forms of the secured loans include loans against securities such as shares, mutuals, funds, bonds, etc. This particular instrument issues customers a line of credit based on the quality of the securities pledged. Gold loans are issued to customers after evaluating the quantities and quality of gold in the items pledged. Comparative corporate entity can also take out secured lending by pledging the company's asset, including the company itself. The interest rates for secured loans are usually lower than those of unsecured loans. Usually, the lending institution employing people on a roll or on a contract basis to evaluate the quality of pledge collateral before sanctioning the loan. Unsecured loans are monetary loans that are not secured against the borrower's assets. These may be available for financial institutions under many different guises or marketing packages. Credit cards, personal loans, bank overdrafts, credit facilities, or lines of credit